Hello, today's topic of discussion is why not have all investments in small cap funds. I am an advocate of gaining higher returns from small cap funds. In fact, the theme of this channel is to attain greater wealth through smarter instruments. But I'll give a balanced view of the pros and cons of investing in small cap funds. We'll also see some strategies in minimizing the risks of investing in small cap funds. High returns of the small cap funds is always tempting and induce FOMO in the investors. They would always wonder why they cannot go 100% in small cap funds. All of us would have got this thought at some point. These are the usual reasons why they think that they can go all in on small cap funds. These scenarios are frequently discussed in various forums. I'm young and I can take risks. My risk appetite is high. I want to build wealth fast. I'm investing for a very, very long time, 20 years or more. There is a compelling reason behind this thought, and we'll see why in the next slide. Why are small cap funds so seductive? For this discussion, I have picked SBI Small Cap as an example. It is one of the oldest and well-performing funds. If you see the trailing returns across 3-year, 5-year, 7-year, 10-year, it's in the range of say 16 to 24%. 5-year returns are higher due to the COVID base, but generally it has been well above Nifty returns. 3 years is 16 point something, 5 years is 24.52, 7 years is 17.73, 10 years is 18.3, all of them consistently above 16 to 18 range. The 5-year returns of 24% means the doubling in 3 years as per the rule of 72. Even for other timelines, at least the money has been doubling in 4 years, which is terrific. This is still trailing returns. The rolling returns are in the same range. Rolling returns are a better barometer of the returns, but they are in the same range. Similarly, the SIP returns as well are excellent. If you assume investing 10,000 per month, which is a very reasonable amount, you can see the returns, you can see the invested amount, you can see the value that you gain at the end of the timeline. Right, 3 years you get 4.46 lakhs, investing just 3.6 lakhs. 5 years you get 9.42. 7 years you get 17.8 lakhs, which is double the investment amount. 10 years is 33.44 lakhs, which is triple the investment amount, right? Which is all very fantastic. I mean, even if you see the returns, 10-year returns is about 19.47, 7 years is 21.1%. So even if you picked SBI small cap fund and just simply kept doing this SIP, you would have gained a lot of money, right? And you can see the reason why small cap funds are so tempting, right? Now, let's try to understand the pros and cons of investing in small cap funds. Now, let's start with the pros, right? Now, the first one is the vast pool of Indian companies in the small cap space. In India, the universe of small cap companies is incredibly vast, with hundreds of businesses that are still growing, expanding, and innovating. Unlike the relatively limited large cap universe dominated by big names like Reliance or HDFC Bank, small cap funds cover this broad spectrum of emerging businesses. This gives fund managers the opportunity to create alpha, which means generating returns better than the overall market by picking promising firms early. Through detailed research, they identify hidden gems in sectors like manufacturing, technology, services, consumer goods, and more. With India's dynamic economy, the scope to discover undervalued companies that can grow exponentially is huge. This is what makes investing in Indian small cap funds exciting. Now, the second one is several fast growing sectors in the Indian small caps. India is home to some rapidly evolving sectors where small cap companies are leading the charge. Think about fintech startups revolutionizing payments, specialty pharma firms innovating new drugs, renewable energy companies powering India's green leap, or niche consumer and rural play companies tapping into India's vast population. Many of these sectors are unlisted or represented mostly by small caps. By investing in small cap funds, you get diversified access to these high growth sectors, driving India's future economic momentum. When these companies grow, it can translate into substantial wealth creation for investors. Third, liquidity. In recent years, there has been a massive inflow of money from Indian investors into small cap mutual funds. This trend is fueled by increasing financial awareness, rising disposable incomes, and India's larger retail and institutional participation in Indian equity markets. Strong liquidity inflows into small cap funds help keep them stable and flexible. It also means they have enough capital to spread across diversified small cap stocks without getting stuck into illiquid ones. This is crucial because Indian small caps traditionally face liquidity challenges, but increased participation is changing the game. This liquidity is a sign of growing trust in Indian small cap funds and their long-term potential. Fourth, directly investing in Indian small cap stocks can be risky and complex. These companies often have less information, transparency, higher volatility, and can be impacted by factors like regulatory changes or market sentiment. Plus, tracking and researching small cap companies in India requires significant effort and expertise. Small cap mutual funds offer a much safer and easier alternative. Your investment is managed by seasoned fund managers who conduct rigorous research and monitor these companies closely. Plus, funds diversify across many small cap stocks, reducing the impact if one company hits a rough patch. For many Indian investors seeking growth but wary of risks, small cap funds provide a professional, diversified, and safer route into India's growth story. On the pitfalls, I've indicated only one, but it is significant. Small cap funds invest in smaller companies which tend to be more vulnerable to market fluctuations and economic cycles. These funds often experience sharp ups and downs in short periods, making them highly volatile. I'll explain more details in the next slide. This is a 15-year graph of SBI small cap NAV. It is the blue line in the graph. We can see that it has multiplied by an impressive 20 times during this period. 1 lakh would have become 20 lakhs, 1 crore would have become 20 crores. But it comes at a cost. The volatility is higher. During the COVID crash, the NAV fell by 34%. Not many people can withstand this kind of drawdown. Similarly, during the recent December 2024 to March 2025 period, it fell by 20%. If investors can use these opportunities to deploy more money during these crashes, they will be rewarded handsomely. In the hindsight, we look back at the COVID crash as a golden opportunity to invest. In the next slide, we see some ways to benefit from these high returns while reducing the risk. So I provide 3 ways to safely invest in small cap funds, each of them progressively more safer. You can use one of them or all of them. Invest for a long term. And you will see staggering returns as we saw in the earlier slides. Do not keep looking at the NAV every day. Invest and forget it, like you do for real estate. For more reduction in volatility, follow a rebalancing strategy, something like 80% in equity, 20% in debt funds. Follow a rebalancing cadence every month or a quarter. This will reduce the impact of the drawdowns. This strategy will inherently book some profits and invest when the markets are down. If you want to reduce the volatility even further, reduce the small cap fund allocation and include FlexiCap. To conclude, do not shy away from small cap funds. They provide a surefire way to greater wealth and should be part of every investor's portfolio. High returns do not come to the lucky, they come to the disciplined. Stick with it. Ignore the noise. Your dream life is already in motion. You just have to keep driving. Thanks for watching. If you found this deep dive useful, hit like, subscribe, and drop a comment. Thank you.